SPY was down 0.53% during Friday's trading session, closing at 601.82. We appear to be forming a short-term double top on the chart. However, from the lows back on January 13th, we appear to still be in this uptrend. Removing the 0 DTE GEX from Friday's expiration, the overall gamma exposure picture appears to be fairly even on both sides looking at the distribution. However, I will note the largest gamma exposure concentration on the SPY is at 620, and it's also at 6200 on SPX. So that's something important to note. Market participants appear to be focusing on this strike as the next potential target, potentially into the February 21st options expiration. In terms of the last 6 weeks of trading, we basically have gone nowhere since this December 18th FOMC meeting where we had the big drop, but you can see we are essentially closing Friday's trading session at the exact same level. So we've basically gone nowhere for the last 6 weeks. Taking a look at the VIX data, we appear to have closed the gap left over from Monday's trading session where the S&P gapped down following the DeepSeek AI news, and we appear to be sandwiched between the 15 and 17 levels on the VIX according to the gamma exposure data. This is essentially showing us that we are in negative gamma exposure on the VIX, which is actually a positive sign for the overall market, as volatility sellers have really come back in play since Monday morning. And speaking of the VIX, let's take a look at implied volatility on the S&P 500. We have our GEX weighted volatility gauge. This is essentially measuring implied volatility over the last 52 weeks, and our gauge is currently sitting at 53.2, meaning that 53.2% of the time over the last year, implied volatility has been lower than what it is currently. When we look at the VIX, we're trading at 1643, which is actually pretty hard to believe that we have been lower than 1643 53.2% of the time in the last 52 weeks. That just goes to show you what a low volatility environment that we are currently in this market. And so until the VIX really maintains above an 18 or 20 for a consistent amount of time, we're going to continue in this low volatility regime that the market is currently in. There's been a couple of attempts recently to break out of that low volatility regime, but volatility sellers are still firmly in control of this market as of now. One slightly more worrying sign for risk on assets is Bitcoin now trading below 100,000 after multiple attempts to try to break above this 108,000 level on Bitcoin. It just couldn't do it, and we've seen a failure now over the last 3 days as Bitcoin has been trading lower, but now breaking below that 100,000 level. We do still have positive gamma exposure, the largest concentrations at the 110 and 120,000 strike. However, I am concerned that these will start falling apart as price trades lower, and so this is going to be a very important zone here between 95 and 90 on Bitcoin. We saw support there multiple times over the last couple of months, and if we do get back into that zone, we need to hold that. This could actually be an interesting area for a long opportunity with tight stops if we do get back down to that level. But again, this sell-off over the last several days is somewhat concerning for risk on assets, as Bitcoin is sometimes a leading indicator when it comes to mega cap tech and the Qs in general. Next, let's take a look at Nvidia. This is actually a name that we have in our current portfolio. We put this position on near the lows here when we were trading around the 117.5 level back on Monday. By the way, if you're interested in following along in our portfolio, you can check out our community Discord for free, link in the description below. So heading into this next week, the gamma exposure data is not looking quite as favorable as it was a week ago. We have a pretty even distribution with large positive gamma exposure concentrations at the 150 and 140 strike. However, we have negative gamma exposure concentrations at the 120 and the 110 strike. So a pretty even gamma exposure distribution in the options market. Currently, zero gamma exposure is sitting right around 123. Of course, that can change from day to day, 125, 122. And we really need to get above this 130 level on Nvidia. You can see a very clear delineation zone right below that 130 level where we have somewhat broken down on Monday. So we need to get back above that 130 strike to get market momentum back in favor. And these gamma exposure effects from the 150 and 140 strikes will really start to kick in if we can get above this 130 level. So for now, trading below 130, this is more of a spec play. We knew that going in, adding this name into our portfolio. And so we factored that in, of course, to our probability assessment. But again, we need to get back above that 130 level to go from a spec play to a more high probability play. Next, let's take a look at Google. Google has earnings coming up after the bell on February 4th. Looking at the gamma exposure data, we've been focusing on this 200 strike for the last couple of months and have had a number of successful trades as we traded down to the 190 strike. You can see multiple times coming right back into that 200 strike. Gamma exposure leading into earnings now has really picked up. We see positive gamma exposure all the way up to the 220 strike. So market participants appear to be really bullish coming into the options market with speculative plays up to the 220 strike. Next, let's take a look at GLD, the gold ETF, closing at 258.56, really has been on a tear since this December 18th FOMC meeting. You can see that was essentially where GLD took off, and now we are approaching the 260 strike. Look at the volume coming in the options market, though. 30,000 contracts traded at the 280 strike, nearly 30,000 contracts traded at the 270 strike. This is actually a position that we've had an option strategy on in our portfolio for the past month. We're going to continue to maintain that position. We're looking for a move potentially as high as the 270 strike over the coming weeks and months. Really happy to see the options volume on Friday looking so strong at these higher strikes, and the gamma exposure picture overall looks really strong on GLD, especially if we can get any kind of consolidation for the next week or two around this 260 level. I think this is setting up nicely with continued volume coming in at these higher strikes that we could have another leg higher, potentially up to that 270 level. And as a reminder, we are running a discount, $300 off our yearly portfolio manager tier subscription. Use code WINTER2025 at checkout. We do have a few spots remaining, so take advantage of that while you can. You'll get access to our gamma exposure dashboard and our option flow analytics tools. You'll also get access to our community Discord in our premium channels, where we have a ton of great traders in there sharing their own trade strategies, market analysis, and of course, we're always breaking down the gamma exposure data. So you definitely don't want to miss that. Link in the description below. Thanks so much, everybody, for watching, and we'll see you guys in the next video.